Hi, everyone. Thanks for being here today. This is a webinar presented by the Behavioral Economics in Action at Rotman and the Behaviorally Informed Organizations Partnership. I'm Colin West. I'm a postdoctoral researcher at Rotman, and I'll moderate today's webinar. So today we're delighted to have Kerry-Ann Spencer-Williams. In this webinar, Kerry-Ann will deliver a 30 to 35 minute presentation. During the presentation, you can submit questions in the Q&A tab, the bottom right-hand corner. And at the end of the presentation, we'll have a Q&A session. So now I'd like to briefly introduce Kerry-Ann. She is the Director of Business Analytics and Evaluation at IGM Financial. She's worked on advancing analytics culture and optimizing data-driven decision-making across IGM Financial for the past 15 years. Through IG Wealth Management's partnership with Bear, she's explored ways to embed behavioral science into the DNA of the organization. Kerry-Ann collaborates closely with internal stakeholders to improve consumer welfare by uncovering and addressing the interplay of cognitive biases and sludge barriers in established processes. She holds a master's in economics from the University of Manitoba, a graduate certificate in evaluation from the University of Victoria, and a first-class honors undergraduate degree in economics and statistics from the University of the West Indies. So thanks very much, Kerry-Ann, for being here today, and take it away.
Thank you very much, Colin. I'll just start to share my screen. Okay, hello everyone. I'm really pleased to join you today from Winnipeg, Manitoba. And that is in Canada. And I'd like to start off by acknowledging that IGM Financial and IG Wealth Management head office and my home office is located on Treaty 1 territory, the original lands of the Anishinaabe, Cree, and Dakota peoples, and the homeland of the Métis. I'd also like to acknowledge that you're joining us today from many places near and far, and acknowledge the traditional owners and caretakers of those lands. So I'll start off by talking about my company and group of companies. IGM is a leading wealth and asset management company supporting financial advisors and their Canadian clients and even institutional investors around the world. Our family of companies provide a broad range of financial planning and investment management services. IGM has almost 4,000 employees and approximately 238 billion in total assets under management and advisement. In the wealth management space, we deliver comprehensive financial planning to over 1 million IG Wealth Management clients and 198,000 investment planning council clients. And in the asset management space, Mackenzie Investments helps over 30,000 external advisors build strong portfolios for more than 1 million clients. And I have the great honor and responsibility of supporting this group of companies in applied research, analytics, and AI capabilities in ways that improve decision-making to increase client outcomes. So what is the X factor that I'm talking about? Fun fact, I love singing, but I don't think that's what you're here to witness today. So luckily, I'm not going to talk about or try out for a reality TV music competition. A simple definition for an X factor usually is an unknown or unexplained element that makes something more interesting or valuable. It could be a variable that will have the most significant impact on an outcome. So another fun fact, I love math. I love math, algebra, and in algebra, we try to solve for X all the time. So that's probably why I've named this talk uncovering that X factor for financial well-being. So if we're trying to take that approach, let's solve for that. And to be honest, I did try to solve for this X factor in the past in my undergrad and master's programs because I was obsessed with the capital asset pricing model. And I wrote several papers and did applied econometric analyses trying to solve for alpha and beta. So quickly, the capital asset pricing model describes the relationship between systematic risk and expected return for financial assets. And to be even more simplified, alpha measures the relative performance of a portfolio, while beta will measure the relative volatility of a portfolio. So if either alpha or beta are the X factor that we're looking for, then portfolio managers should be able to actively trade funds or create diversification strategies to earn excess returns over the market. Of course, the CAPM is quite elegant, but it fails in practicability over time because investors, people like you and I, we're not all homogenous. We are not all risk-averse actors, and we do not operate in frictionless, perfect markets that don't have taxes and other imperfections, like the theory would require. So in a series of studies, including the surrounding studies over time, the verdict has been found, and it basically is that the alpha, which we'd find from stock picking, does not outperform the market. We'll also see that diversification, which is that beta, only returns marginal positive value over time. But what we've seen is that significant returns can be enjoyed by Canadians over time if they receive and act on good financial advice. So this value of financial advice is what we call gamma, which is the first clue to unlocking this X factor. Gamma captures the cumulative impact of working with a financial advisor to create and follow through on a sound financial plan. So it's more than just portfolio construction. The surrounding studies confirm that because of greater discipline in savings, investing, and diversification, and even maintaining that discipline over time throughout market volatility, advised households see increases in assets 2 to 4 times that of households without advice after 15 years. So these outcomes are observed even when we control for the starting asset levels, financial and economic context, and even the propensity of clients to save. So gamma is basically the sum of having that plan, but connecting the client with an advisor that ensures that they follow up on that plan and improve that plan over time. So now you've heard a little bit about me and the X factor that we're trying to solve for. Now it's your turn to share with me in this first poll. So what percentage of Canadians do you think have a financial plan? And these statistics will be from a survey done on a broad cross-section of Canadians, asking them this very question, whether they had a financial plan or not. So I can see that the first option is in the lead, and the second option is just behind. Okay, so I think we have enough results in. So those of you who said 60%, that's actually correct in terms of Canadians saying that they do have a financial plan. So let's look at the next question. What do you think a holistic financial plan includes? So you can select from all the options on the screen, 1 or 2 of them, any combination you think is the right one. Okay, so definitely I see in the lead investments and retirement planning, definitely included. And many people have selected a combination of the others. So the actual answer from a financial planning perspective would be all the above: investments, retirement planning, planning your cash flow, planning a safety net with insurance and emergency funds, and even estate planning. How do you leave your money behind when you're gone? So thank you for that. And then lastly, of the people who said they have a financial plan, how many of those plans do you think focus exclusively on investments? Okay, great. So I see 75% and 90% are really close, and you're in the right vicinity. Most people are, because it's upwards of 75%. So thanks very much for giving me that feedback. So clearly, there is a gap. So you may have seen this ad in this fall highlighting that people deserve more from their financial plans. They should have a comprehensive financial plan, like the one that IG Living Plan creates, which addresses the 6 pillars of financial well-being. As I had mentioned before, all those options are important pillars of a full, comprehensive, holistic financial plan. So of course, this ad was a great play on a fun fall activities and just saying you deserve more, right? Who doesn't like that? So having a customized financial plan is only the first step, however. To ensure that clients are on track to meeting their goals and can enjoy financial security and confidence through various life stages, there needs to be dialogue, adjustment, and implementation. They need to be working closely with that financial advisor. So there needs to be action from people. And this is why we try to center people in our processes. So IG has world-class asset managers, well-trained and experienced financial planners supported by internal specialists. And we have first-in-class digital tools powered by data science and AI. This will help to unlock the full potential of the tools and assets that we have. To be able to do that, we've partnered with the Behavioral Economics in Action at Rotman to research what are the barriers along the entire digital journey of initial search for an advisor, which is that awareness stage, to onboarding and commitment of new clients, and then to the ongoing client-advisor relationship, where there needs to be annual or even occasional feedback as life changes. So I want to give you some quick examples of how IG is leading in making behaviorally informed decisions that nudge advisors to creating and updating financial plans for their clients, and also nudge clients to act on plan recommendations, because this is how we will maximize gamma. So the insights I'll share today are related mostly to the ongoing client relationship and annual review section of our client journey. So our very first behavioral economics project, I probably didn't mention before, but we've been working with Bear for the last year and a half about. So we've had a year full of projects, and we've done several projects. And I'll just talk about the first and second ones, because those are the ones that focused on this ongoing relationship stage. So we focused on our financial advisors adopting new and updated financial planning software. We've always had financial planning at the core of our business value, and we've used the latest technology. In the last 5 years, we've made rapid planning tool enhancements with the IG Living Plan and rolled it out to our advisors. But even good change, like updating your cell phone, takes some getting used to. So we wanted to address what the experiences were as advisors transitioned to a new system of creating and updating clients' plans. The first area we focused on was change management. What we found were instances of information and choice overload, value perception, loss aversion, and procrastination, which is just natural when you're using a new tool and you have to read through, understand what are the differences. So what we found and how we addressed these issues with change management was, in one instance, we created this Gamma Opportunities dashboard. So this would reduce all the information that they'd have to consider to determine what conversations to have with their clients first, by creating a dashboard that guides that conversation between specialists and consultants or advisors to help them to take action on the planning opportunities. And what we've seen is that this has led to an increase in the tool usage, integrated, updated financial data transfer that's been faster, and therefore improving the financial plan quality of clients sooner. The second area we focused on was training. What was their training experience like? So new tools require training and several hours to engage efficiently with. So what we heard from our advisors was, in our research, was that there's a lot of information and the training modules were a bit overwhelming. And so therefore they could procrastinate and just stick to the old ways of doing things. So what we did was to redesign our learning platform and break down modules into ordered micro-learning lessons that are more easily completed at the learner's pace. And we also embedded quick survey feedback so that we could make modifications sooner as we were learning from them. And of course, with better training means faster implementation and better outcomes for the clients who benefit ultimately. And then the third area in addressing the advisor usage was, we know that we always had a culture of financial planning. It's been embedded in the way we've done business for many decades. What we learned when we spoke to our advisors was that maybe our incentive structure, as well-rounded as they probably weren't as effective, because we know people respond to incentives. However, sometimes the framing of an incentive could make an incentive feel like a carrot or a stick. So what we learned was that there are more cost-effective ways to have that implementation, and nudging through social incentives seemed perfect. So financial incentives alone were not very impactful. What we did was to create a Jeff Carney Award, which is in honor of our previous CEO, and it was personalized. It was public facing. It was tied to public donations and media, and it fit the bill of inspiring competition among advisors, who many are type A and like to be acknowledged for winning and doing great work. It also raised their advisor profile within the community to existing and prospective clients. So we basically connected to their internal satisfaction that they received from giving good financial planning, which is what they really cared about. So this just helped us to diversify our incentive structure, including that social recognition, which they gave us very positive feedback on. So after focusing on changes within the organization and our advisors, we looked into how we could motivate clients to take action on the recommended next best steps that they could take when they access their online accounts. So our second project highlighted the focus on clients and the Gamma recommended opportunities that they would see when they opened their account and got the AI-powered online financial plan recommendations. So we know from research that a lack of implementing financial advice is an example of the intention action gap, where individuals want to do the right thing, but because of myopia or inertia or just lack of confidence in decision making, they might take a while and might not follow through. So to encourage them, we use social norm comparisons, or actually we're developing social norm comparisons. So these will nudge based on providing that positive influence and pro-social behavior change, because people like to know that they're doing the right thing, especially relative to other persons. So what we're developing are ways to share clients' plan scores relative to other investors who are similar to them. We're also looking at optimizing or recommendation wording and framing of the progress that they make on their goals. So prospect theory suggests that the losses weigh more heavily on the conscience of investors. And so we should use loss aversion to reframe recommendations as losses, which will nudge clients more quickly to the desired beneficial action. So these are things that we're in development, we have in development for our clients. And we've also explored a lot of other things on the search side of things. But I just want to, jump to the overall takeaway that we've learned is that while we have the best talents and tools in the financial services industry, they can only go so far in achieving financial confidence and security. To unlock the full impact of Gamma over time, we have to focus on the people who will use them. Now, importantly, we have to think of people as humans and not econs. It's great to think that we're rational, but in my days, I've seen that or rationality is quite bounded, and we don't always make the same decisions that we or better selves might think that we would under certain situations. So in addition to using incentives to bring forth the desired outcome, we want to use gentle nudges that are not intrusive, that will make the desired actions easier to follow through on. And to do this, we have to consider what are the motivations of persons that we're working with, what matters to them the most. How are they processing the information? Is information too overwhelming? Is it too much? And what are their perceptions and biases and emotional responses that they're having to the choices that we're putting in front of them? So to conclude, the X factor is in centering the best tools and processes around real human behaviors. It's not just about having the best plan, but how are we making sure that advisors and clients are continuously working on that plan and updating it as life changes to optimize their financial outcomes. So that is all for my presentation today, and I'm open to questions.
Thanks very much, Kerry-Ann. That's great. So for anybody who wants to ask questions, you can pop it in the Q&A. We also have Michelle and Gatan to help field some questions. But I can kick things off. We'd like to just be conversational from here. One thing, Kerry-Ann, is you've got a data savvy audience here, and I know this is kind of core to what you do. One thing that I think we'd be curious about is how you think about what we call selection effects, right? So you think of, okay, are people who are working with financial advisors already more responsible and patient to begin with? And when you introduce new tools, how do you think about measuring the impact and avoiding this concern that, the most responsible people are the ones who go work with financial advisors, and of course they have better outcomes. So from a data science standpoint, how do you think about that?
Yeah, that's a great question. I believe that in the Serrano studies, they also had encountered, that perception. Is it that clients who are more susceptible, more open to getting advice, they're the ones connecting with advisors, or is it advisors who are approaching clients that are connecting with people who have enough investable assets and therefore continuing to build on that wealth over time? In our own world of data science and in my role of measuring the impacts of certain actions, we always try to control for that selection bias, who is making who has the underlying motivation and intentions of always doing good no matter what. right? And always adopting tools and best practices. So some of that is observable and others aren't. So for the parts that are observable, when we collect data, when we have data on our or staff or consultants or advisors and any information we have on clients, we try to compare them to people who are within the same starting points, the same geographical locations, the same level of, and this would, quote unquote, if we know information on their education, for example, their social environment. So anything that we can test to figure out what is important in cause and action, we try to include those in our models, and so that we can control for them. So we can see the real impact of the financial planning, tool usage, and gamma over time.
Okay, so in that, are you tracking people who are not IG clients who fit a similar socioeconomic and behavioral profile and then comparing them against, or is this all within the IG clients and looking at, so maybe tell us a little bit more about how you think about controlling for these selection effects.
Mm-hmm. That is a good question. For internal audiences or for our internal data science work, we will use our own database of clients that we have. But we do partner with academic institutions that will have a broader set of data that we do not use that, but we do have access to that. And then we'll probably compare notes on what are the differences in the population. So.
Well, okay, changing gears a little bit. Kind of two ends of the spectrum that I think are interesting is kind of the young people who are just kind of starting to become investors, and then older people who have to think about what you might call decumulation decisions. How do I spend down some of my money in retirement and towards the end of my life? So maybe starting with the first group, we hear a lot about how young investors are really impatient. They're all on Robinhood. They're trading options instead of being responsible. From your experience and the data that you've got, one, is that true? Are young people especially irresponsible today? And then how do you think about building financial planning for a population of people that are used to doing things all online? Maybe they're less interested in the one-on-one. How do you think about those, the young investors today?
Yeah, I would say that, no, I personally don't have that perception of young persons. I know that they're probably more inclined, what we did see in the BEAR studies, that they're more inclined to be searching online and using our tools to find an advisor, even though some would do more robo-investing. There are others who are very open to working with advisors and getting financial plans. I would ask Gaetan if he's on the line to chime in on this particular question, though.
First, hi, Kerry-Ann. So can you hear me okay?
I can.
I don't see my video on. Is my video on?
No, it's not.
Oh, not sure how to activate it. So apparently I have a stop video option only, so I'm not sure why. So just imagine a very attractive, older looking gentleman speaking to you right now. So that on the question of young people and older people, I think, Colin, it's a really good question. And in our experience, of course, there's the great thing about creating categories of individuals is that there's a huge amount of exceptions and ranging within those categories. So what we do see, though, is that the brand of young people being more impatient and trading options and going after a lot of quick wins. I think that's probably those that get the most attention. It's probably the one that the group that tends to be the most highlighted in media and in research. But realistically, there's a lot of individuals within all age groups that are very open and interested in good financial planning, good advice. And what we see with younger people, when we look at them in terms of our own client base and where we want to attract young people to the IG Wealth Management brand and the business. There's definitely a very large amount of young people who are very interested in sound financial advice. And sometimes it could be just in the area of confirming an approach that they believe is going to be helpful. So just, can you take a second look at this and let me know if it works well? And often what they're looking for is better advice, not just on their investments, but also their mortgages, because young people tend to have a larger mortgage than older people do. They're also interested in better protection for their family as well. Young people with young families, their biggest asset usually is their ability to earn income over time. And so having that insurance conversation as well, and that fits really well in how Kerry-Ann positioned that holistic financial plan should include, insurance, mortgages, estate planning. You should really think about the entire picture, not just your investments. Young people tend to have a lot of potential, but not a whole lot of investments, and therefore that holistic plan becomes even more important for them.
Thanks, Ketan. Yeah, that's great. We have a question from the audience here that I'll relay. Matthew has asked about how you are using some of the external data that you use. So, you've got, of course, good data on the clients from IG Wealth and how their financial behaviors are changing, their financial plan. But then Matthew was interested in how you think about external evidence that might not be aligning perfectly, and maybe just an example of how you've used external data to redesign some of the financial advice that you provide to clients.
So, Gayton, if you do want to chime in on this, you can, but I would say I don't have a very clear example to say when external data had been contrary to what we've seen. We have over 1 million clients in our database, and so it's pretty representative of the population in Canada specifically. And when we've looked, even as our strategy changes over the decades, like we've been in business since 1926, even when our strategy changes, we've had relationships with clients who started out with almost no assets, and then 50 years later, they're millionaires. And other people who started out as business owners. We have people from a very broad cross-section of society. So it's very rare that we see contradictory data. What we have seen is that our clients will have, generally, when we give them the IG Living Plan assessment that they can do internally or online, when we compare that, let's say we have IG Living Plan snapshot for, I would say, for prospective clients or people who are searching for advice. And when they fill out those, when they do the assessment and get a score, we compare it to the score that we have for internal clients. We actually do say that our internal clients have higher financial well-being scores. So that's not contradictory, it's just different from the population because our clients do have good financial plans. So I think outside of that difference, I haven't seen it. I think over time, our client base, if you track them over time, their social and financial status changes over time. But in terms of cross-section data, they're pretty reflective of the general view of investors across Canada who have assets who want to invest. So I haven't seen that big contradiction. So I haven't had that problem of trying to use, different ways to counter it.
Got another question from Andrea that I might just expand upon a little bit. Andrea was interested in whether the gamma that you were talking about can be achieved just from the digital interaction, or is the human element, like in person or meeting with a real person, really critical? And maybe I'll just build on that a little bit of how do you think about identifying which parts of the holistic financial plan are really doing the work? You could think of, well, maybe it's really just about getting people to carve out some savings in the first place. And that's the really critical piece. One of the challenges from a data science standpoint is this kitchen sink approach. You're trying to help your clients, so you're doing a holistic plan, but then, it's a kitchen sink intervention. We don't know which piece is really working. Maybe one of the pieces is doing all the work and another one is doing nothing. From a financial planning standpoint, giving a holistic approach obviously makes a lot of sense, very prudent and responsible. But from a data science point, it gives us a real challenge of well, what is working and what parts are critical. So maybe just think about one, do you think the human element is critical, and maybe what data would back that up? And then broadly, just how do you deal from a data science standpoint with this problem of the kitchen sink?
Yeah, those are great questions. So to tackle the first one, yes, the human connection is critical. When I spoke about that digital client journey, that was looking at one area in which we want to make the change, make the enhancements, because especially we're doing in the last 2 years, a lot of people's interaction is digital, and people have been less social and engaging. So the ways that advisors probably find clients, or clients find advisors, would most things have shifted onto digital channels. And we wanted to make sure that we're having very smooth processes that enable that financial plan. And so we wanted to make sure that all channels are open, right? So usually if you're not being introduced to someone, you're going on Google and doing a search, you're finding our website, you're choosing the best advisor that you search for that matches your own criteria of what an advisor should do, and then you're connecting with them. So we have a very heavy emphasis on connecting with the advisor. One of the things that came out in our research was just how to make sure that they're connecting without any delay. So that connection, that or statement is about engendering that real relationship over time, right? So the human connection is really important. I do see Gaten chiming in. Maybe he wants to chime in on the first part. So I'll allow Gaten. I don't know if you wanted to chime in now, or I should continue.
No, you can continue, Kerry-Ann.
Okay. Okay, great. So yes, the human element is super important, and we're not advocating to just have a digital client experience. It's not robo advice. It's definitely see the tools, have access to the tools, use them, get the AI recommendations, apply them, but always talk to your advisor about making the changes. So there's always a meetup or a communication, whether it's digitally or not, but there's always that human connection. That's really important, because it's about the relationships that we build. Because what we also found in the research, trust is essential in the financial advice space. So you don't just trust a computer or a visual that you see on a computer. So the human element cannot be separated from this.
So being provocative for a moment, how do we know? How do we know that the digital advice can't outperform? This is a direction that a lot of industries are going of, oh, how can I scale this? How can I do this cheaper? And intuitively, it makes sense that, oh, I'm going to trust a human more. But do we know that from a data science perspective? How do we produce evidence that shows really that this human element is so important?
That is a great question. I would say there are limitations, to what you could see online and believe. Like when you think about a financial plan, it's not just about, again, so it's not just the investments, right? I know your second part of the previous question was which one is most important. And first, yes, you start by saving. That's number one. And I think secondly, you think about how do you protect those savings in case of an emergency? So there's insurance. And then as you build up, you start to think about, how do you make big purchases and manage your cash flow daily? And then what do you leave behind? So there definitely are levels to what is important. And it's not everything just thrown in the mud and everything has the same result. But going back to what you just asked me, remind me.
Well, Gaetan, I know wants to jump in, but
yeah,
Gaetan, jump in before I go back. Yeah,
I thought it was a good question. I'm like, oh, that's a great question. How do we know? And we are definitely there's a high level of kind of assuming that this model is a successful model, and so it's not. So I would start by saying it's not necessary to prove that it is better or worse. It's a different model, digital only versus human only versus a hybrid digital plus human. And I think all of them can be very successful. And so, there's room for all models of advice. I would also say, though, I think, I can't recall a specific study, but we had looked at things like fund flows during volatile markets and whether they end up if people are making good decisions, post volatility. And, if you take the notion that, buy low, sell high is a good thing, what we see is that that tends to be the opposite that happens largely, but it happens less with when there's a human advisor involved, because you do have that opportunity to discuss the situation with somebody you trust prior to taking an action. If it's fully digital, then you might be more, let's call it trigger happy, and just say, oh, I don't like this volatility, I'm going to get out. But lasting through volatility is a really important part of long-term wealth accumulation, and people can easily destroy their wealth by overreacting to volatility. So we do see that as, let's call it, one area of evidence that a human intervention can be very helpful as part of achieving a larger gamma effect.
Right. So I also remembered my tangent, right? When we're looking at financial plans, people are when you're in crisis, so thinking about that volatile situation, people want to be able to talk to someone as well, because so the human element is really important. And I remember the Serrano studies also showing that when people drop their advisors, they also lose that advantage of gamma that they were building up over time. So even if they had the plan, but they didn't have the advisor to ensure that they were following through all the time and updating it, then we saw that shortfall.
Yeah, and I noticed Michelle added to the chat a little bit there. Michelle, did you want to jump in with any other thoughts?
Sorry, I wish I could quote the actual organizations that have done it off the top of my head, but I can't. But there have been many studies done on the value of advice versus what investors tend to do left to their own devices.
Yeah, thinking from a research standpoint, right? What we would look for is either longitudinal panel data where you could see the same person moving from using digital advice only to starting to work with an advisor, and then you could look at within-person changes. There'd be one way to do it. The other might be what we would call an intent to treat design, where if you reached out to a new market and you randomly assign people to either encourage them to start off with digital only versus others that involved a hybrid versus one that involved a big human element. Now we've got random assignment, we can get causality, because there's a real tricky thing, right? The big challenge is the type of person who works with an advisor might also be the type of person that resists volatility. So it's a real tricky challenge that you guys are really well positioned from a data science standpoint to be able to answer these tricky questions. Gitan, did you have another comment here?
Yeah, just quickly, Kerry-Ann mentioned the Serrano study, and that because they've done it like for many, many years, there is a longitudinal aspect of it. So in that study, they were able to identify individuals who had advice and then dropped advice. And when they compared them to match individuals, they do see that their outcomes were not as good as those who had maintained that advice over the same period of time. So that it was never intended to be a longitudinal study, but the fact that they had within their database as individuals who had responded to the same survey over years, they could actually have a good angle and a good dimension of that. So to that point, there is some evidence of that. I do agree with you, Colin, though, that I think it'd be a great way to better understand the impact that each individual component of an advice relationship can have, and how it can really be a rich place to understand what kind of interactions are most useful in what circumstances. And definitely from a behavioral economics perspective, we tend to the human aspects tend to be really important, but there are good ways to achieve similar outcomes through a digital interaction as well, with the right messaging, right nudges, time of day, messaging, and actions as well.
Yeah, I mean, this is such a fascinating challenge from how do you scale some of the financial advice so that more and more people for low cost can access some of this versus, which parts really do involve this kind of more analog human connection so we just thought from a data science standpoint, really interesting. On a related note, we've got a question from Chelsea here on the two ends of the spectrum that I started with, the accumulation versus decumulation. And how have you guys thought about what types of interactions are most important at these different stages? Do you think of, you really need digital tools at one stage, you really need in-person at another? How do you think about a client moving from accumulation to decumulation would be what Chelsea has asked.
I think, yeah, well, our own approach is always to be fully integrated. I think we're moving, in the past, we always had just a human approach, and then we take all the information, we go away, we print out the financial plan, we give it to you, you sign it, you read it, you update it in a year. And now information changes so quickly, life changes fast, and we want also for clients to have access to their plan and to be able to make changes much quicker. And I think the stages of life also determine how quickly someone needs a response or action to be taken. But definitely our standard is, minimum once a year. And then as you go along as needed. Personally, I can only think about like maybe half of the life stage or life cycle for myself to personally say, what point is more important. I can imagine that, when you have life events, then it's right away. And when you need to make big purchases, the turnaround needs to be short, and being able to see those two, see your dashboards and see your trend and not have to wait too long to be able to make changes is really important.
One thing I would add, Kerry-Ann, is in terms of interactions, there might be some subtle differences in level of interactions by age, say, or by life event. It does tend to be more about the, let's say, what level of discussion do you need to have with your advisor, and the more intimate the discussion, the more likely that would be to be done in person. I would see, in terms of the data that shows that, this seems to be very much a data focused group, which is great. It's kind of hard to be able to really identify the specifics of what are the combinations of circumstances that would lead to a digital interaction being more or less successful than an in-person one. There's also one of the key ones as well is the proximity, the actual physical proximity to your advisor. If it's easy and convenient to be able to meet with an individual, you're more likely to do that than if it's a 1 hour drive and parking's difficult and so forth. So, and if it's more transactional in nature, then those tend to be more conducive to digital interactions. If it's more about an exploration or scenario building or having a real discussion where you're not sure where you want to end up, those I would see them as being mostly successful through a face-to-face interaction. But even with, again, the last couple of years through the pandemic have shown that many of what we usually consider being a in-person only interaction has been very successful, being done through digital channels as well. So I think we're seeing an evolution there, and that's true at all stages. I don't think there's a big tie between age and digital interactions. We've seen a lot of successful individuals at all age groups use digital tools to be able to interact with their advisors.
I wanted to move a little bit to a question that I'm interested in, and that's financial education and literacy. And I wonder what you think about this area, because you can only have so much control over what a client does if they are, low financial literacy or don't have a high financial education outside of their interactions with their advisor. They could undermine their financial plan, right? And I'll put kind of one provocative data point on the table here. There's been some research showing like financial education has been notoriously ineffective. There's been millions of dollars poured into the school system. There's been nonprofits working around the world providing financial literacy training to people to households that are mid or lower income. And the results have been really discouraging. Right? When you train people and you give them an education course, it doesn't change their long-term behaviors. And there's some great meta-analyses showing that financial literacy training has been notoriously ineffective. So when you guys think about your approach to financial education and financial literacy, given some of these challenges, how do you see the future of financial education and financial literacy, and how do you think that fits into the interactions between advisors and clients?
Yeah, I think, that research is very solid and grounded. I think that we have recognized that financial literacy is already very low within the country. And we've been trying to do, things in terms of offering, whether it's training and also encouraging youth to learn those tools and to apply those tools, right? We've done publications. So we do see that there's a gap, and we've tried to fill that gap. To your point, however, is that sufficient? And I think it's really important to have persons working with someone, right, as a mentor. So I think there's that role for the advisor, because the information could be online, but if you're not practicing it, then you don't change your behavior. To change behavior, it's easier to work with someone who you respect, who you see that has more knowledge than you in a particular area, and then following through on recommendations. And I think positive outcomes reinforce that positive, good behavior and behavioral change. So if, as they're working with a consultant or an advisor, and they're seeing that they're able to save way more than they could in the past, that they're able to purchase a home, that they started their business and they could make the most tax efficient decisions during that time, then it slowly changes behavior within the community. But definitely education, even though it's fallen short, it's really important as a starting point.
Yeah, agreed. And adding to that, it's financial education and financial literacy are absolutely essential to long-term success of Canadians, and IG definitely connects to that. And you working a financial advisor is a great way, but not everybody has the ability or the incentive to do that. And there's a lot of other programs available as well. Financial literacy is, if our clients, if they don't have a high level of financial literacy, they don't fully appreciate and understand the value of the work that our advisors give them. And so it's important. And IG is quite committed to that. And you may have heard of the IG Empower Your Tomorrow program, which is intended exactly to address the financial literacy of Canadians, and in particular at-risk groups who may not have access to fulsome education or programs to be able to help them. And so it does provide those opportunities. Oh, I see Kerry-Ann popped the link. Thank you, Kerry-Ann.
You're welcome.
It does provide that baseline of what many individuals would take for granted in terms of understanding finances. Not everybody does, and so it provides a nice way to introduce individuals that may be at risk to better financial advice and resources.
I wonder what you think about two trends that have become more popular, and whether you think these show promise. And these two are what you might call learn by doing financial literacy, or just-in-time financial literacy. And this is the idea that providing people with resources often doesn't work. What you need is tools and targeted advice at the right time. Wonder what you think about those. Do those show promise? How do you think about kind of changing financial literacy so that it is more effective?
Could you explain which one is the just-in-time approach?
Yeah,
of the first two that you mentioned.
There's been some studies showing that if I do go through a 2-week-long course on financial literacy, and then I follow up 6 months later, and I look at whether my spending, saving, investing behaviors have changed, the answer is often no. But if I provide like smaller amounts of targeted advice right at the right time. So I'm thinking about whether to take out a mortgage. I'm thinking about I just got a raise at my job. How am I going to allocate it? If I provide take away the week-long training course and just provide tools at the time of a decision. There's some researchers and financial institutions that think this is the real future of financial advice. No more training courses. We're going to provide tools at the right time. What do you think about that approach?
Yeah, so I think the training is still important as foundation. However, I do know that there's a decay factor with you do an online learning, you do anything in school, like do you remember everything that you learned in school, and can you regurgitate that knowledge and use it and apply it right now? Probably not. So the learning by doing is essential to making sure that it's formed a habit and it's changed the way that you behave and move forward. And then even in the research, thinking about information and choice overload. If you have all this information, you might do nothing with it. But when something is relevant and actionable and bite-sized, then you take action and it connects to you cognitively, that you remember, and you see the impact of it. So I like that approach of that just-in-time method. However, I think having that foundation is still important, because you never know when you can reference it, or you see something that makes you recall it and then you act on it. So I think both are important, but I definitely like that second part of that just-in-time approach being leveraged way more now.
Well, we're down to our last minute here. So I'll say thanks very much to Kerry-Ann and to Gatan and Michelle for leading our webinar today. You can find a recording of this on the website, on the BEAR website under the events tab. And we'll have another webinar. Our next one is on November 16th with Michael Halsworth from Behavioral Insights Team Americas. So with that, I'll just say another big thank you to Kerry-Ann for answering all these questions and for your presentation. It was a pleasure.
Thank you, Colin. Thanks, everyone.
And thanks, everyone, for attending. And have a great day. You can just
Thank you.